Hi, my name is Kim Watson. In this video, I'm going to look at one of the best indicators out there, the RSI, Relative Strength Index. This is a part of my new Best Indicators series. And what I'm going to look at then is the best settings, how to set it up correctly, the best time to use it, when it should be used, when it should be left alone, the best way to pick up trading signals, and finally the best way to enter the trade using those signals. We're going to go straight over to look at how to set it up first. So what I'm going to do now is apply the RSI to the charts, and I'll show you my settings. Now I've actually applied it to this chart. It's hidden at the moment, but I'll just show you. This is TradingView. It's a very common charting package, very good charting package. You just need to click on the top here. You can search for it using relative. If you start putting relative in, it's right at the top of the list there. There are other versions of it, and every man and his dog has made it slightly different or whatever, but you just need the standard RSI to start off with. Then you can make some adjustments if you wish to. Now I find my settings better than in the original, but only slightly. It just makes it a little bit more easy on the eye. Firstly, this is the standard setup and the way it comes with a moving average. I don't like the moving average over it. It's supposed to be showing some smoothing. Some people will use the moving average then for the signal for the signal line to break through it or whatever. It just complicates matters. So the best thing is to look at it in its purest state. So firstly, because I make it a little bit more aggressive, it's currently set on a 30-70. That's the default setting, and the default period is 14 days, 14 periods rather. So that's default. So let's get rid of this and then look at my preferred settings then. So I've changed it down to a 6 period. It's a little bit more aggressive, and then I've adjusted, and I'll show you how I've adjusted very briefly, very quickly. So going on here, I've just changed the length to 6 period, and then when it comes to the style, I've changed it to 80 and 20 as the upper band and the lower band effectively. It's just a little bit more aggressive at times. It just shows things a little bit clearer when you're looking, and it just gives you the quite early heads up. So when do we use the RSI? The best times to use it. The best times for the RSI is when the markets are a bit more choppy, because it's an oscillating indicator. If you just look, it's going between effectively 0 and 100, and it will give readings around those. Now, some people would just sell it when it hits the high and buy it at the bottom there. How you do that, it sort of works, but doesn't work in a trending market. It's pretty awful in a trending market. It's a little bit easier when the markets are going much more. They're chopping a lot more. As soon as you sort of get into trending markets, you'll get into a point of you'll see consistent buy signals like here, for example, and yet really you should be looking in a downward trend for the sell signals, and the sell signals not coming up here because it's just too weak, this market at that stage. So, but it is giving you very clear buy signals. Now the buy signal's not moving very far, so it's not great for trends. It's very good when the market gets choppier, or I say it's very good if the market gets too choppy, and you see this very slow price action here, and this is a daily chart, I would add. So it's not like I've picked something particularly low time frame or something, but you can see how choppy it can be, and it's just chopping. It's just in a very range bound. And what does it show you? It shows it's chopping. What does the price show you? It's chopping. And what's more important, the price or the indicator? Of course, the price. So the price is showing us chopping, so we just stay out of it and we don't try and get into any trades in. When it starts pulling through here, then as I say, my preference is to use it. If you were looking at this sort of buy-sell process, it would be when the markets are much more volatile and choppy, so that we've got some potential for it to be moving back and forth. How is the best way to pick up trading signals from the RSI? Now, I will look at it and I'll use divergences. So the key point here is I'm looking for the divergences. I'll show you what a divergence is in a moment, but I'm looking at them where the bigger time frames are still in the favor of the direction I'm looking for the price to move. So in other words, if the market's coming downwards and you've got a downward movement, I'm looking for retracements, movements that are coming up which then show a divergence. So it gives me then an entry in terms of the bigger direction. It's the safer direction. That is what I'm looking for in the market. Now, other traders would just trade any old divergence, and that's why a lot of traders are quite unsuccessful in what they're doing, because they're trading against what is, on a bigger scale of things, a big trend. Now, I'll just show you briefly what a divergence is first. Now, this is cherry picking. I'm literally cherry picking because not all of the time will you see clean divergences. Sometimes they're as clear as day. Other times you're looking there, and if it's uncertain, walk away, leave it alone. So let me show you what divergence is. Here, between this first point and the second high, so we've got the second high has come in higher than the first point. We've had the retracement and it's pushed up. So what you've got is you've got your, if some people were looking at it as overbought, it must hit at least the 80 points, the 80 line on here, which it has done, for me to be interested in the divergence in the first place. It must have come up to 80 first, and then it's pulled back. The price is pushed up then into a new high, and then that's where it's given me a lower movement in terms of the price actions not showing the same as what the strength is. If this is a strength indicator, it's strong at the top, it's weak at the bottom. So if the price action is moving along in a nice strong action, price action we're seeing here, and the strength's moving up, that's fine. So when we're getting a retracement and the strength of that new move is weaker than the previous, that opens up a question, and that's just literally a question, nothing else. Is this market ready to sell? Now, there are times, and this market, as you can see, I just wanted to show you what a divergence looks like. This is a bearish divergence, and you'll get a bullish divergence. It's not completely down to the 20 area here, but it's got the principles behind it. So the price has given us a new low. So the price has given us a new low, yet what we're seeing at the bottom here is some strength. So there we go. So price in this particular case has moved upwards a little bit, then back down. It's showing a move here, but it's a weak move effectively to the downside because there's strength coming into this market, and we've already seen that because of the price action in between the two lows went up. It showed that there's some strength in there, just the way we saw some weakness in this market already before it put the new high in. It's showing there is some potential weakness. Now, these are the signals that we're looking for. They must, though, this one's slightly, I said it's slightly adrift, but it's close by to show you an example. But it must have hit the 20 on my use here of using period 6, or if you're using a standard 14, it must have hit at least the 30 and the 70 for the highs. But it's much better to have the settings I've got here. They're just clearer often. Okay, so there's divergences. How do we trade them? So how do you actually get into the position? You've got a possible setup, but it's not triggered at this point. It's up to you to decide on the triggering point. Now, the best way to do it, in my opinion, is Wilder method. The original method is probably the best, although I'll show you an alternative as well. So his method was to be looking at for a long, so for this long position, he would be seeing the divergence coming in. He would let the price come down here. That's fine. That's given us the divergence. He wouldn't try to buy here. It's not about buying buying bottoms and selling tops. It's about getting a trigger into that trade. This isn't a trigger point. This is just hope. Well, I hope it's not going to go down any further. I've spent enough time previously trying to buy these lows and sell into the highs, only to see the divergence disappear and the price continue to push up. So they're not absolute. This is a signal, it's so strong, it's the only one to follow. These are signals which should be used in trend. What he would look for was in this case of this example, you've got your two lows. He would look at the high between the two lows to be broken to get into the trade. So it's only when it's actually broken here, around about here, is at this point he would be looking as a buy. How you exit, etc., is really a principle of other trading, and to make it a proper strategy, you need to have an understanding of stop placement and exiting. What I'm showing you here for now, though, is the signal and how you might trade it. So this is the first example. This is Wells Wilder's example. What happens then? This is the short example. Now this is pulled down, pushed up, pulled down, hasn't made a new low, hasn't triggered the trade, but gone back up again. Now to me, this suggests where there might still be strength. You don't know what happens next. You only ever see what's happening at the time. As soon as you start seeing it popping up and pushing through here, to me, I'm not interested. It's not a clean position. This is nice and clean. This long was nice and clean. It just went and went and went and pushed up thereafter. This isn't pushing up. So this one would be, I would ignore it. There was an example up here though. If you look, it's very fractional. It's still a divergence. We had the high coming in with the RSI at this point here, and then we had a fractionally new high. It's a softer divergence, I call this, but it still made a fractional divergence. But look at the RSI, it's weaker. So there was a divergence over here, and this then suggested on the break here that would have been an entry. So that would have been the entry according to Wells Wilder's methodology. So very, very simple process, and by doing it this way, it's just that bit more conservative. You're not trying to catch the top, you're not trying to catch the bottoms, you're catching at the best possible time when it's showing its hand. And boy, this has moved its hand quite well today. That's where we are with the divergences this way. I will just show you one other way as a slight alternative to waiting all the way up here, is to use trend lines. I've just popped a trend line on there. One other way is to be popping the trend line over the previous highs. Now this, because it hadn't made the low at that point, we would be putting it across there, and so you might get in slightly earlier on this particular occasion. On this example here, you wouldn't have got it. There was no trend line. Oh, there was a trend line, but yep, it had diverged. Sorry, just you could have been looking at the lows across here. Let's just adjust that slightly. So across the lows there, and just again got in fractionally earlier. So it's a slightly more aggressive way of getting into the same trade slightly earlier. Of course, it could just come back to those lows and bounce on the lows and continue upwards, but this is, as I say, slightly conservative. You could place the first trade and add in on the second move. So it's just a method that I will use sometimes, as opposed to waiting for it to come all the way flat. But I'll only ever use the strategy where if I'm trading off this time frame, I'd be looking at the bigger time frames, and they would be showing me that the market is already coming down. So I'm trading it with the upper time frames working, and the short time frames are just showing, okay, this retracement's finished now, it's getting a bit weak, and the market's rolling over. So there we have it. A very simple processes. You've got to go back through the charts and get your eye in first. Don't just take it as the next one you see and start trading it. Look at the more simpler approach in terms of using either Wilder's method or my slightly more aggressive trendline version. It might just give you a quicker, an earlier entry, but either way, test it, look back all the way through on the charts. Now, some strategies work better on some markets. This would work quite well in a big oscillating market. If the market's chopping along, this could work quite well. So you're looking at divergence into the highs as opposed to just overbought or oversold signals. There's just more confirmation in this. Now, hopefully you enjoyed this video. If you do, please give me a like below, and also do feel free to subscribe to my channel for more videos like this.